Hello everybody, welcome to Monday Morning Must Knows. My name is Merlin Rothfeld, and here are three important things to pay attention to for the upcoming trading week. Now last week, all eyes were on Apple and Amazon, and they disappointed and didn't disappoint. Amazon looking great with their earnings, nice pop we saw on Friday off that announcement, but Apple not looking so good, down a couple of percentage points, and that dragging those markets down with it. We also had some pretty interesting announcements with regards to U.S. debt, which we'll talk about here in just a second going forward. So let's kick things off with our earnings calendar. That's really where we want to start this. I know it's past all the big FANG stocks or the seven samurais, I like to call them. There's a lot of big names that have already passed, but we do have a few big ones coming up for this upcoming trading week. So let's start there. On the earnings front, you've got 1,809 companies reporting. There are a ton of them. On Monday, you've got Skyworks, Tyson Foods, Palantir, and Lucid. Tuesday, you've got Eli Lilly, Duke Energy, United Parcel Service, Take-Two, and Akamai. Wednesday, you've got Disney, Illumina, The Trade Desk, Wynn, Honda Motor Corp. Thursday, you've got Alibaba. That's it. And on Friday, you've got a goose egg. So rounds out a quiet tail end of the week, but we do some bigger names earlier in that week, which may be in your portfolio and therefore may have a little bit of price movement. So be careful. And again, I've cherry picked just the big names. I don't usually go with the smaller market cap companies. So if you have holdings in your portfolio, check your earnings calendar. It will be to your benefit. Okay. Big talk track all year. Inflation. I know it's getting old, but we do need to keep an eye on it because we're seeing a separation between CPI and PPI numbers. And of course, the Fed looking at the core PCE price index, which we will get next week. So let's take a look at this upcoming week's announcements for consumer price index and for producer price index, which should be rather exciting, I think. On Thursday at 8:30 a.m. Eastern time, we have the consumer price index numbers coming out. Right now, the expectations are they're going to stay right where it's at 0.2. You can see on the hard right edge of that chart, 0.2. Well, that would be pretty good. If we can get that annualized and get 12 readings, right, 12 months in a row of CPI at 0.2, that would put us at 2.4% inflation on consumer price index, and that's right where the Fed wants it to be. Now, coming out later in the week, on the tail end, on Friday, producer price index coming out, that number is actually expected to increase, going from 0.1 to 0.2. Now, this is an interesting dilemma to have because what we want to see is CPI numbers dropping and PPI numbers dropping, right? If it costs producers more to make that product, we should see things rising. In this case, consumer price index numbers expected to stay the same. You would anticipate that producers would be paying the same amount as also for those goods and services. But if we see the PPI numbers increase, you have to ask yourself the question, where is it going to come from? If producers are paying more for those goods and services that they sell to you and me, but you and I are paying the same price, there's a math equation that doesn't quite work there. So either we're going to see the CPI numbers start to creep back up, which would not be good, and that would further bolster the argument that the Fed should keep raising rates, or we'll see that PPI number level off and start to go back down. Now, we don't know which way it's going to go. All we do know is that at those respective times, on Thursday and on Friday at 8:30 a.m. Eastern Time, we should see some big moves happening in those markets. So this is the big stuff. Inflation, of course, is still number one on the eye of the Fed. We had unemployment numbers come out on Friday, which are way better than expected. I mean, people thought unemployment levels are going to be rising. We went from 3.6 to 3.5. We're actually going down on unemployment. Awesome problem to have. Lastly, let's look at the final piece for the day, which I think is extremely important, and that has to do with what happened last week. You had the Fitch rating agency downgrade U.S. debt from AAA, which is prime. It's the highest level you can get. Think of it like an 850 credit score. Then they downgraded the U.S. government to AA+. Now, let's be honest here. If AAA is an 850 credit score, then getting downgraded to a AA+ is like still having like an 830. It's still great. However, it's a warning sign to the industry that there are some problems with the government and the way that the government is run. And Fitch cited inefficiencies with the government and problems with the way that they run things currently. Shot across the bow when the rating agencies say that about the government. Now, there are other rating agencies out there. Of course, we have Standard & Poor's, and we also have Moody's. These are the three prime giant rating agencies that rate just about everything that has to do with debt. Now, if Fitch came out and downgraded U.S. government debt and S&P and Moody's did not, it raises the question, is there solidarity amongst these rating agencies? Do we see S&P and Moody's also downgrade from AAA to AA+? If that does happen, you could see more shock in the system. And I'll be honest, personally, I feel like this is long overdue. I felt like we should have done it years ago and downgraded the U.S. debt, because now we have like 130% debt to GDP ratio. We're going back into 2000s. We were like at 56, 58, right? We're all of a sudden seeing big swings in spending and rampant spending that is just unsustainable. So if you're someone who's rating the U.S. debt, probably a good idea to downgrade a little bit, because there is more risk of failure to pay those debt obligations. So this is going to be an interesting one, maybe not just for this week, but over the coming weeks. If we see S&P and we see Moody's start to downgrade U.S. debt as well, that might create more jitters in the financial markets and show solidarity among these rating companies. Now, let's look at what the chart looked like and the reaction to this. Here is the chart of the 10-year yields. When we look at the 10-year bond, this is the yield that it pays if you were to purchase this. And you notice that going from left to right, it's been on a steady increase. On the hard left side of your chart there, it was at 0.98. Imagine when you could get yourself a 30-year fixed rate mortgage for under 3%. Yeah, those are days of the past. Right now, that 10-year has gone from right around 1% up to 4.2. What you can see here is a pattern that starts to form. On the right-hand side of your chart, you can see it's been hitting its head against 4.2%. Some might call this an ascending triangle, some call it a big uptrend, but all in all, it's a series of higher highs and higher lows. That is a very bullish sign, meaning the probability for yields to go higher is higher. Right now you're at 4.2%, but what if we get to 4.5, 4.6, 4.8? And if we get Moody's or we get S&P to downgrade that U.S. debt further, then we could see these yields really start to spike as confidence in the U.S. government to pay its debt starts to wane. So this is a really important thing for you and I going forward. Could present a ton of volatility. And of course, volatility equals opportunity. If you know how to manage your trades right, position size right, and make sure you have a plan in place for all these actions, could be some great trading opportunities going forward. That, my friends, is your Monday Morning Must-Knows. We will see you next week.